HIMS and Hers Health went from a $42 million profit last year to an $86 million loss this quarter, and management still raised full-year guidance. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. HIMS and Hers Health gets graded and traded. So on the top line, revenue came in about 4% ahead of estimates at $753 million. But here's the catch. Most of the growth was juiced by the eucalyptus acquisition that closed in June. Strip that out, and organic domestic growth was closer to 16%, not the 38% headline. And on EPS, the reported number came in more than 600% below estimates. They swung to an $86 million loss versus a $42 million profit a year ago, but that's largely acquisition costs and non-cash items. Adjusted EBITDA was still positive at $60 million, down from $82 million last year, so the operational picture isn't as ugly as the headline suggests. So on the beat itself, and remember, we're grading the tile numbers here. This earns a D. A 4% revenue beat is fine, but a headline EPS miss that big, even with acquisition noise, is what the tile is showing. And on consistency, this earns a C. Their track record of beating has been solid on revenue, but the bottom line surprises have been choppy, and this print doesn't clean that up. Let's talk about the positives from the report. Revenue grew 38% year over year to $753 million, and management raised the full-year guide to a range of $3.1 to $3.3 billion. That's a real vote of confidence in the back half. Subscribers hit almost 2.9 million, up 19% year over year, and the monthly revenue per subscriber jumped 21% to $92. So customers are paying more per month. They're successfully upselling into higher tier offerings. International revenue went from basically nothing, $7.5 million, to $131 million in a single quarter. That's the eucalyptus acquisition kicking in, and it gives them a real international growth engine. Cash on the balance sheet grew to $610 million, up from $228 million at year-end. So they've got plenty of runway to keep investing in the international ramp and the AI clinical platform. And here's the one that matters most operationally. Domestic U.S. revenue re-accelerated to plus 16% year over year. That's the number that anchors the whole forward story, because the international boost is a one-time step up. So on profitability, this earns a D+. The revenue and subscriber trends are real, but I can't grade profitability higher than that when gross margin fell 12 full percentage points and they swung to a GAAP loss. Now, let's talk about the negatives from the report. Gross margin got crushed. It fell from 76% last year to 64% this quarter. That's a 12 percentage point contraction driven by the eucalyptus mix and higher fulfillment costs. They swung to a GAAP net loss of $86 million versus a net income of $42 million a year ago, and adjusted EBITDA fell to $60 million from $82 million. So they're spending ahead of the revenue curve to fund this international expansion. Free cash flow was negative $68 million for the quarter, and working capital consumed $329 million in the first half, largely from a receivables build tied to the acquisitions. That's a real cash drain. General and admin expense more than doubled to $165 million. Total operating expenses grew 48%, while revenue only grew 38%. So operating leverage worked in reverse this quarter. And on the balance sheet, they took on some real acquisition-related obligations. Deferred acquisition payable of $703 million, plus convertible notes climbed to $1.37 billion. That materially raises the financial complexity here. So, on guidance, this lands at an A-. They raised the full year revenue range to $3.1 to $3.3 billion. They raised adjusted EBITDA to $275 to $325 million. And the Q3 guide implies continued sequential acceleration. That's a real vote of confidence. And on red flags, I'm at a C-. Between the negative free cash flow, the receivables build, the deferred acquisition payables, and the convertible debt climbing to almost $1.4 billion. That stack of concerns is real, and I can't wave it off. Putting it all together, this is a print with two very different stories running in parallel. The top line and the guidance raise are genuinely bullish, and the international expansion gives them a real second growth engine. But underneath, gross margin got crushed. They swung to a GAAP loss, and the balance sheet took on a lot more complexity. This is a growth investment quarter where management is deliberately trading near-term margin for scale. Overall, I'm giving this print a C. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. The raised full-year guidance to $3.1 to $3.3 billion in revenue, plus domestic growth speeding back up to 16%, gives me a real fundamental floor to start a position here. But that 12 percentage point drop in gross margin tells me not to chase the post-earnings pop. I want the margin story to clarify over the next 30 to 60 days before I get aggressive. So my move is to sell cash-secured puts at strikes about 10 to 15% below the post-earnings price. That captures the juiced implied volatility and gives me a cushion while the eucalyptus integration noise settles out. That's why I'm easing in with cash-secured puts and skipping the top tick. The raised revenue guidance and 19% subscriber growth give me enough confidence to sell cash-secured puts a little closer to the current price than I usually would on a name this volatile. That said, the margin compression and the swing to GAAP losses mean I'm not reaching for maximum premium. My strike floor sits at pre-earnings support that would still hold if second half gross margin stays at 64% instead of recovering. And I'm only pushing the strike ceiling higher if I'd genuinely be happy taking assignment, because the acquisition integration risk is still very much on the table. So I'm selling closer in, but I'm not reaching for premium. I'm holding my shares. The 38% headline revenue growth and the raised full-year guidance confirm the reason I own this thing in the first place. The number that matters most to me for the next 12 months is that 16% domestic reacceleration. That's the signal the core business is speeding back up, not slowing down. The only trim trigger for me is if third quarter gross margin trajectory disappoints. Management just committed to $880 to $900 million in revenue and 9 to 11% adjusted EBITDA margin, so a miss on that concrete bar is when I'd lighten up. I'm holding and watching third quarter margins closely. With guidance raised and international expansion optionality opening up, I'd rather roll my covered calls up and out than let a near-dated strike get run over on a top-line surprise. When I pick new strikes, I'm assuming elevated volatility all the way through the eucalyptus integration period. I'm not capping my upside at a strike that doesn't pay me enough for another positive revenue surprise against that $3.1 to $3.3 billion guidance. The only time closing early makes sense to me is if implied volatility crushes hard and I can redeploy the premium into fresh contracts with better strike positioning. So I'm rolling my calls up and out. My LEAPS thesis is still anchored to the 2030 targets of $6.5 billion in revenue and $1.3 billion in adjusted EBITDA. Nothing in this print changes that. The eucalyptus deal actually strengthens the international leg of that long-term story, so I'm holding what I have. I'd only roll up if my position is deep in the money and I want to lock partial gains while extending duration. The thesis breaker I'm watching is sustained gross margin below 65% into 2027. If that 64% print becomes structural instead of temporary, the path to $1.3 billion in adjusted EBITDA gets a lot harder and the LEAPS math changes. I'm holding LEAPS and watching gross margin closely. This release validates my original growth thesis rather than breaking it. Domestic reacceleration to 16%, raised full-year guidance, and a successful eucalyptus close are all positive check marks on the bull case for me. Averaging down works for me if my original thesis was mostly about revenue growth and international expansion. It works a lot less well if my thesis needed near-term margin expansion because that just moved the wrong direction. So I'm adding in pieces tied to gross margin data points rather than dumping everything in at once. The margin story is the single biggest variable that'll drive the next 6 months of price action. I'm adding in pieces as margin data comes in. Bottom line, this print earns a C from me. The revenue reacceleration and raised guidance are real, but the margin compression and balance sheet complexity mean the next couple quarters carry real execution risk. Thanks for watching, and I'll see you on the next one.